Here's something nobody tells you. That credit score you checked this morning, the one sitting inside your banking app or your credit card portal or that free website you signed up for, it's not your credit score. It's a credit score. One of potentially 49 different scores that currently exist with your name on them. And the score you're looking at right now is probably not the one your bank will use when you actually need it. Most people spend years carefully paying their bills on time, keeping their balances low, and doing everything they were told to do. Then they sit down to apply for a mortgage or a car loan and find out the number a lender is looking at is completely different from the one they've been tracking. Sometimes by up to 50 points, sometimes more. So, if the score you're obsessively monitoring isn't the real one, what is? Who's actually in charge of this? And how did we end up in a world where a 3 digit number quietly determines whether you get a house, a car, or sometimes even a job? That's what this video is about. To understand how we got here, you have to go back to what lending actually looked like before any of this existed. Before the 1980s, whether you got approved for a loan came down almost entirely to the judgment of a local bank manager. They'd look at your application, maybe look at you, make a call, which sounds personal and human, until you realize what that actually meant in practice. It meant that discrimination was rampant. Women were routinely denied credit without a male cosigner. Black applicants were rejected at rates that had nothing to do with their finances. The system wasn't just inconsistent, it was openly biased and largely legal. Congress started addressing this in the 1970s with laws like the Equal Credit Opportunity Act and the Fair Credit Reporting Act. But legislation alone didn't solve the underlying problem, which is that there was no standardized, objective way to evaluate borrower risk at scale. That's the gap that FICO stepped into. In 1989, a company named Fair, Isaac, and Corporation, you know them today as FICO, releases something new. A single standardized number that tells banks how risky a borrower is. One number, simple, consistent. No more guessing, no more relying on the gut feeling of whoever happened to be sitting across the desk from you. Banks love it. Within a few years, nearly every major lender in America is using it. And by 1995, Fannie Mae and Freddie Mac, the two giants that back most American mortgages, officially adopt FICO as a standard. At that point, it's basically baked into the entire financial system. The original intention was genuinely good, replace a biased human judgment with an objective math-based system. And in some ways, it worked. Access to credit did expand significantly in the decades that followed. But like most systems designed to solve one problem, it quietly created several new ones. Here's where it gets complicated. FICO doesn't actually collect your data. Three separate private companies do that: Experian, Equifax, and TransUnion. They're called credit bureaus, and what they do is gather information about you from banks, lenders, and landlords, and also public records. Your payment history, your loan balances, your credit card accounts, any bankruptcies or collections, all of it flows into these files these companies maintain virtually on every American adult. FICO takes that raw information and runs it through their formula to produce your score. But here's the first thing most people miss. Each bureau has slightly different data on you. Lenders aren't required to report to all three bureaus. Some report to all three. Some report to only one or two. So your payment history at Experian might look slightly different from your payment history at Equifax. An account that exists in one file might not exist in another, which means your FICO score calculated from Experian data is almost certainly different from the one calculated from Equifax data, which is again different from the TransUnion version. That's already three scores, but we're just getting started. FICO has been updating their formula for decades. There are now multiple active versions of the FICO score: FICO 8, which came out in 2009 and is currently the most widely used; FICO 9, released in 2014, which treats paid-off collections differently; FICO 10 from 2020, which weighs trending data, meaning it doesn't just look at where your balances are today, it looks at whether they've been going up or down over time. Each version treats your financial behavior differently. An action that hurts your score under FICO 8 may have less impact under FICO 9. A collections account that's dragging down your score today might be ignored entirely under FICO 9 once it's paid off. But FICO 8 doesn't work that way. On top of the version problem, FICO makes industry-specific scores. If you're buying a car, a lender might pull your FICO Auto score, which weighs your history of car payments more heavily than the general credit behavior. Applying for a credit card, they might use FICO Bank Card score. A mortgage, lenders are currently required by Fannie Mae and Freddie Mac to use three specific older FICO versions: FICO 2 from Experian, FICO 4 from TransUnion, and FICO 5 from Equifax. Even though FICO has released significantly newer models since then, there's been movement to update those requirements, but as of now, the mortgage industry is still running on formulas that are decades old. When you add up all the FICO versions across three bureaus, across all the industry-specific models, the total is over 49 distinct scores. All of them yours. All of them calculated from your data. All of them potentially different. And to make things even messier, in 2006, the three boroughs got together and created their own competing scoring model called Vantage Score. Same general idea as FICO, but a different formula that produces different results. Vantage Score is now on version 4.0, and it's likely what you'll see in most free apps like Credit Karma, Credit Sesame, and many banking apps display Vantage Score because it's cheaper for them to license than FICO. So when you log into your banking app and feel good about your score, you're almost certainly looking at Vantage Score that no lender you'll ever work with actually uses, or an older FICO version that's not relevant to whatever you're applying for. The score you see and the score they see are not the same score. Okay, so how do they actually calculate any of these scores? FICO has disclosed 5 general factors through the exact algorithm and is proprietary, meaning they've never published the precise math and they're not legally required to. All we know comes from what they've chosen to share publicly. The biggest factor, making up 35% of your score, is your payment history. Have you paid your bills on time? Every time? This is the single most important thing you can do for your credit. One missed payment reported to the bureaus 30 days after the due date and can drop your score by 50 to 100 points overnight. And that mark stays on your report for 7 years, not 7 months, 7 years. The second factor, another 30%, is credit utilization. That's the ratio of how much credit you're using compared to how much you have available. If your credit limit is $10,000 and you're carrying a $5,000 balance, your utilization is 50%. Most financial advisors will tell you to keep it under 30%. The reality is that most people with the highest scores typically keep it under 10%. Here's the part that confuses people. Utilization is calculated from your statement balance, not from whether you pay it off. So, even if you pay your card in full every month and never pay a dollar of interest, if your balance is high when the statement closes, that high utilization is what gets reported. You can be completely debt free and still have a utilization problem. The remaining 35% is split across 3 factors. The length of your credit history, which is how long you've had accounts open, rewards you for age. The mix of credit types you carry. A combination of revolving credit like cards and installment loans like car payments signals that you can handle different kinds of debt. And finally, new credit. How recently you applied for things. That last one is worth dwelling on. Every time you apply for a credit card or a loan, the lender performs what's called a hard inquiry. They formally request your credit report to evaluate the application, and that inquiry itself lowers your score slightly. It's temporary, but it stays visible on your report for 2 years. So the system literally penalizes you for trying to access credit as part of how it decides whether you're trustworthy enough to have credit. If you're starting from a thin credit file and trying to build your history, you're penalized for every attempt to do exactly that. Now, here's the part of this story that most people have never stopped to think about. Equifax, Experian, and TransUnion are private, for-profit companies. They are not government agencies. No one elected them. Congress didn't create them to perform this function. They grew into this role organically because banks found them useful, and over time they became so embedded into the lending process that they became effectively impossible to route around. These companies collected detailed financial data on virtually every American adult without asking permission and without any way for you to opt out. You never signed an agreement with Equifax. You never gave TransUnion your information directly, but they have it anyway because the banks and lenders you actually did business with report it to them. And under current law, there is no mechanism to remove yourself from the system. In exchange for being the infrastructure that quietly determines who gets to participate in the financial system, these companies sell access to your data, and they generate billions of dollars in revenue doing it. Experian alone reported over $6 billion in revenue in a recent year. They are, at their core, data companies, and you are the product. To be fair, the system isn't entirely without oversight. The Fair Credit Reporting Act gives you genuine rights. You're entitled to a free copy of your credit report from each bureau every year through annualcreditreport.com. If there's an error on your report, and research has consistently found that a significant percentage of credit reports contain errors, you have the legal right to dispute it. But the dispute process has a well-documented flaw. When you submit a dispute, the bureau investigates. But that investigation is largely automated and typically routed back to the original lender who reported the information. The same party who may have made the error is often the one deciding whether the error occurred. Disputes are frequently resolved in a matter of days, not because someone carefully reviewed your file, but the lender confirmed the original data with the code and the bureau accepted it. And even when a dispute is successful and an error gets corrected at one bureau, there's no automatic mechanism that corrects it at the other two. You have to dispute it separately, 3 times with 3 different companies for the same mistake. Let's make all of this concrete with real numbers. Imagine 2 people, same age, same income, same job, same neighborhood, apply for a $300,000 mortgage on the same day. Person A has a credit score of 780. Person B has a score of 620. Maybe person B went through a rough patch a few years ago, a job loss, a medical bill that went to collections, and has been rebuilding since. Their finances today are identical to person A's, but the score still reflects the past. Person A gets offered an interest rate of around 6.5%. Person B, if they're approved at all, might be looking at 8.5% or higher. On a 30-year mortgage, that 2-point difference in interest rate means person B pays approximately $150,000 more over the life of the loan. Same house, same purchase price, same down payment. Just a different 3-digit number assigned by a private company using a formula no one outside the company fully understands. And this dynamic doesn't stop at mortgages. In most US states, insurance companies are legally allowed to use your credit score when setting your car insurance premiums. Landlords use it to screen rental applications. Some employers, particularly in finance and government, run credit checks as part of hiring. The score follows you everywhere, into decisions that have nothing to do with whether you pay your Visa bill on time. So, what do you do with all of this? The first thing is to stop treating the score in your banking app as a number that matters. Use it as a directional signal. If it's going up over time, you're doing the right things. But don't make major financial decisions based on it. And don't panic if it swings a few points from month to month. Minor fluctuations are normal and largely meaningless. Second, know which score is actually relevant to what you're trying to do. For most personal loans and credit cards, lenders use FICO score 8. For a mortgage, you need to know your FICO score 2, 4, and 5, the older versions that mortgage industry still requires. You can access your actual FICO scores at myfico.com. It costs money, but if you're about to apply for a mortgage, knowing your real score before the lender pulls it could save you from surprises at the worst possible moment. Third, and this might be the single most valuable thing you can take from this video, pull your credit reports every year from annualcreditreport.com, not your score, your actual report. Read through it. Look for accounts you don't recognize, late payments you don't remember, addresses that aren't yours. Errors are more common than the industry would like to admit, and an error on your report is costing you money every day. It sits there uncontested. Finally, understand the leverage points in the system. Payment history and utilization make up 65% of your score. Those two factors are almost entirely within your control. Pay on time, every time, even if it's just the minimum. And keep your balances low relative to your limits, not because you're in debt, but because of how utilization gets calculated. The credit system is opaque by design, managed by private companies with no real democratic ability, and built primarily to serve lenders rather than borrowers. But once you understand the structure, the competing bureaus, the multiple scoring models, and the 49 different versions of your financial identity, it stops feeling like something that happens to you. It starts feeling like something you can actually navigate. If you want to understand the next hidden system quietly running in the background of your financial life, subscribe. New video every week.